It is time now for On the Radar, a closer look at what money managers are watching on the markets. And this morning, Ryan Lewenza is with us. He's a portfolio manager at Turner Investments, Raymond James. And we're going to talk about the theme of seasonality. Probably the most commonly referenced seasonality term is sell in May, go away. For what it's worth, if you had sold at the start of May, the S&P 500, which is now about 6.5% since then, didn't necessarily work. But why does seasonality make your radar to begin with? Why is it worth discussing at all?
Well, there's two things. One, the data. So the data shows that the markets are, on average, weaker in the summer period. Here's a great stat. On average, the S&P is up 7.5% from October into May, and is only up 0.5% from May to October. So the data proves this out. Now what we're looking at here is the monthly average performance throughout the calendar year. And you can see that August, September, all our viewers should make a note of that. September is historically the weakest month of the year. So this just shows that over the summer, you can see those bars, there's some negatives. There's small gains during the summer. July is an outlier. That's typically a little stronger. But typically, markets are a little softer. Now, I would add a couple more things. So basically, I think we're going to see a bit of a pause, consolidation, maybe even a pullback. One of that is the seasonality. The second thing is the technicals. The S&P has had a V-shaped recovery. We're now at a key technical resistance around 6,100. So we got a resistance level. I would add we're overbought. One of my favorite indicators is the percentage of stocks above the 50-day moving average. So you look at all the S&P, all 500. What is the percentage of those that are above the 50-day? Only at right now it's at 74%. That's a lot. So basically, I think the technicals suggest a bit of a pause. We've got a chart up here of the S&P. Look at the January, February highs. That's going to provide a resistance level. I would add with the big V-shaped recovery, we've got the PE at the S&P now at 23 times. That's elevated. And then we got geopolitics. So long story short, I see a period of consolidation, a little bit of pullback here, nothing crazy. We raise some cash. And if I'm right, we redeploy that in September and pick up some bargains.
And just to tie back to the geopolitics, which you referenced, do you think that if the market feels a little stretched, and I was saying earlier, there's an indication that market participation's getting thin.
Yes.
And then you've got kind of like this worrisome headline out there. It's kind of like a salad that and it's summer.
Yep.
So people kind of tune out a little bit.
Little bit. So the participation is two things. One, we've had a huge recovery and people have benefited. So what's the net new buyer coming in? So that's declining. And it's summer. We're going to our cottages. We're going on vacation break. People pay just less attention to the markets, and that's a factor of why you get that soft period. And then I just throw out the geopolitics as another catalyst that could be one of those things that, hey, market was down 4% for a week kind of thing.
You know, if you're working with a professional investor like yourself, who's very strategic about this stuff and ready to redeploy the cash that you raise when you think there might be a bit of softness in the markets, that's one thing. If you're doing it yourself, because there's all these stats out there about, like, if you miss the best such and such days in the market each year, then over time, your returns really start to lag.
Yeah.
So sometimes, tuning out in the summer and just leaving everything in place might benefit your portfolio more so than trying to time it yourself. So what would be your advice to someone who's a do-it-yourselfer?
Well, take how we try to implement the strategy. It's not an all-in or an all-out.
Okay.
Right? Oh, well, I'm going to leave on May 1st and I'm going to re-enter on thing. Absolutely not. You stick with that long-term plan. Let me be clear. Our view, our macro view, is that the markets are going to be in the green this year. When we close December 31st, we think we're going to be up. So be on the long side of that. So what we do is we just raise some cash within the portfolio. So maybe a 2 to 3% is kind of a low cash weighting, and maybe you have 5 to 7% through the summer. Take just a few chips off. So it's not this all in, all or nothing kind of trade. We do not do that. We're long-term investors. We're trying to get those long-term themes. But do you raise a little bit of cash after a huge recovery and in the weak seasonal period when there's an escalating Middle East tensions? That's prudent.
And only 30 seconds left, but you talked earlier about keeping an eye on the international markets. When you get back to business, let's say in September, are you still on the fence about whether, go harder with international versus the U.S.? Do we have to work through a couple of these other factors, but that's on your mind right now?
Well, this is where the market and those technicals come through. So this is where you be patient. You've got the fundamentals. We talked about the valuations, talked about the stimulus. And then if we get that relative strength breakout, price is truth, as they say in our business. And once you get that technical breakout, whether it's July 15th or September 1st, if we get it, then you start to make moves around that.